You're listening to the Final Say Radio Show, a Rappaport Media production, with your host Brett Rappaport and co-host John Rappaport.
We have our first guest of the program today. Joe Lawler is with the Washington Examiner. And Joe, thank you so much for joining us today to discuss some of these incredibly important issues, which unfortunately with all that's going on internationally with regards to foreign policy, we sometimes forget that economics are so important to us, but we have to cover some of these issues, so thank you again.
Thank you for having me on.
Joe, if we can, start with the highway funding, which has been a part of one of the recent discussions. The idea that, we've seen some accusations going between Congress and the White House, or between both houses of Congress, as to why we're not funding certain programs. And if you can, to clear up a few things, the first question I would have is it really necessary for us to push for an increase in the gas tax? And two, is this really a matter of we haven't properly funded the highway funding, or that we've spent some of the money in this fund on things that misappropriated, if you will, of the funds?
Well, I think there are two ways that this could potentially go. One is there could be so the Highway Trust Fund is underfunded badly. We know that. Over the next 10 years, it's a $170 billion projected shortfall. Could be more than that. And looking out over the long term, it's even bigger than that. So if a gas tax is a solution, the one proposal that was offered on a bipartisan basis was to effectively double it, come close to doubling the existing gas tax, and that might get us through the next 10 years. But then beyond that, even that wouldn't be sufficient to address all the needs of the country, because for a few reasons, just because we're spending so much and we have so many needs, and also because people are driving less and are driving more fuel-efficient cars. So if that road entails even higher taxes, higher gas taxes than we're contemplating right now. The alternative, there's a lot of alternatives out there. It could be something that there's a greater role for the states to determine what their needs are, for experimentation with different ways of collecting revenues and different ways of setting priorities, and that might be an option to consider, given how rapidly our transportation needs might be changing based on who knows what the future holds in terms of what our cars will look like, even 10 years down the road. So I think that's basically the two big things to think about.
Yeah, that's an interesting point. And I know one thing that I've read, and I recall this going back for some time, the argument of the inequality or the unfairness, if you will, of a gas tax, and that is, if you instill a mileage tax, people who live in areas where even just to get to a local convenience store to buy milk, it may be a 10 or 15-mile drive just because the land is vast. It's unfair for people who, just to go seek any type of job, will have to drive significant distances to do so, as opposed to someone who lives in a city who might be able to just walk out their door and walk up a block or even catch a train. And so it's a disproportionate tax, if you will. And so that's certainly something to be considered.
Absolutely. There's all kinds of questions about equality, about privacy, about how if you're talking about a miles traveled tax, how are you going to collect that? About, what are our cities going to look like? What are our suburbs going to look like? A lot can change in 10 years, so certainly a big consideration.
Now, one last point before we move on to the next topic. When I look at when this president, or even towards the end of Bush's term in office, dealing with the housing crisis and trying to stabilize the economy first, but then get it going again, with these massive stimulus packages, and we heard all the language of shovel-ready projects that we could spend the money on, which we now know that we paid $74 or $76 million for signs that told us that our stimulus money was or your federal stimulus money at work, were all the guardrails that were put up in places that you were wondering why guardrails were required. And it turns out that we spent a lot of money on things that weren't necessary and ignored the significant lapses in some of our roads, the deterioration of major bridges and things of that nature. And now we're having to deal with that when we essentially, I don't know, what did we waste? $1 trillion, maybe a couple $1 trillion over these last 6-7 years?
Well, I think that's, it sounds like you're coming down on the side of let's devolve control over highway funding to more to states and localities that have a better sense of their priorities. And I think that's certainly a reasonable way to go. And, it's, I think, a fact that even the president was aware of. I'm sure you're familiar with his comment that the shovel-ready jobs turned out not to be so shovel-ready as we thought. And the stimulus bill, the 2009 stimulus bill, a third of it was spent on a third of it was tax cuts, a third of it was aid to states for things like Medicaid, and a third of it was spending. So, we're talking about $250 billion, and not all of that was highway spending, but yeah, it was a lot of money, and I think it's reasonable to go back and look and say, is the best way to plan for our transportation needs through measures intended to be, an emergency response to a crisis. So.
Sure. Now, we're going to switch topics now to the area of jobs. And I know my co-host John is going to he's a serial entrepreneur for many decades now, and he will have some follow-on questions. But first I'd like to ask, we have been creating somewhere in the neighborhood of 200,000 plus jobs. I think it's, maybe 5 or 6 months in a row now. So, of course, it's an improvement. But when you delve deeper into the reports, it seems like we're not necessarily creating a higher quality jobs or full-time employment. And then the add-on question I would have to that is I've been told by many economists over the years that in a good economy, if you're not producing 250 or 350,000 jobs every single month, you're not actually keeping up with the growth of your population. And so I think we're falling short on all these areas. So I'll leave you to comment on that.
Sure. I think that the number required to keep pace with population is not quite that high, but you're right. We need to be adding a certain amount of jobs just to maintain the employment to population ratio, and we weren't doing that for the first few years after the official recession, official end of the recession and official beginning of the recovery. Now, I think so far in 2014, we've created 230,000 jobs a month, actually, according to the BLS. That's more than enough not a lot more than enough, and I don't think it's enough to keep the employment to population rising. Now, is it enough is it what you would think would be consistent with a healthy economy? Maybe not quite there yet. Is it consistent with what you would expect with a recovery after a serious downturn? And there the answer is no, and we've been looking for that for 5 years, and it hasn't come, and whether it's ever going to come is a question that's open for debate. But, it's 203,000 jobs a month this year, which is significantly better. It's only 190,000 last year and only 180,000 the year before that, so that's pretty clear improvement.
Joe, are there any metrics that we could look at that would provide a reasonable... Remember we had under Carter, we had the sort of economic pain index. I forgot exactly what they called it.
Yeah, the misery index.
Thank you. I couldn't think of that. The misery index. Is there any kind of equivalent speak or terminology that would compare the growth in new jobs, but as Brett pointed out, indexing those to various things such as how many new jobs are there versus the growth in the population, the hours of those jobs, the average wages of those jobs, indexed to inflation, and maybe even other things such as the sustainability and impact of those jobs. As you know, there are jobs that are very temporary in nature. There are jobs that are very easy to outsource overseas. So are the economists in any way coming up with new misery indexes that help to really give us a fair analysis, putting the politicians aside?
Yeah, that's a great question, and I think the answer is that the economists and the government would love to have a reliable statistic like that. They let them know clearly which way things were headed, but they don't. But there are a few things that you can look at. One is the broader rate of underemployment, which is published by the Bureau of Labor Statistics along with the headline unemployment rate. So as opposed to just unemployment, that includes people who are working part-time because they couldn't find a full-time job or their hours were cut. It includes people who are they have jobs they know are temporary, or they have jobs that they just finished or are looking for other jobs. So it captures a lot more of the economic pain than the unemployment rate. So the unemployment rate right now, the headline one that you hear reported in the news, is 6.1%, and that underemployment rate is 12.1% in the latest data from June. So it gives you maybe a broader sense of where things are. And now it's come down pretty significantly too. I don't know off the top of my head, but it peaked well above 15 during the worst of the recession. I think that the other thing you need to look at is wage growth, because when the labor market is tight, wage growth is high, and right now we've had just very meager wage growth, and in fact, if you look at it over the past year, it hasn't outstripped inflation. So I'm not aware of any one statistic that combines all those things, but you can kind of take a look at a few different measures and get a sense, and certainly the different indices of wage growth we have are signaling that the unemployment rate is not capturing all of the weakness in the market right now.
I think wage growth is a very important issue, and I always have a hard time because I have my own politics clearly, but I'm a big fan of performance over propaganda. So again, if we try really hard to take away my right-leaning bias, is there a sense in your mind that the need for low-income people to raise their income and the push from the Democratic side of the aisle for a relatively high minimum wage, do you see that as something that might actually have positive side effects given the number of people driven toward part-time jobs, or is that likely to increase the reliance on part-time jobs and eliminate the normal stepladder effect that part-time jobs traditionally provided to the economy?
I think that's a really big question. Clearly that raising the minimum wage has been a big part of the president's agenda this year. I think maybe the best way to think about it, or one helpful way to think about it, is the report that was put out by the Congressional Budget Office earlier this year. I'm sure they score budgets and keep track of costs for Congress, and they're nonpartisan official budget office for Congress. And they took a look at the raising the minimum wage to the 10-10 level from what it is currently, and their findings were it would raise wages for a lot of folks who are in low-wage jobs right now, and I forget the exact number, but millions would receive a wage increase, but at the cost of somewhere in the range of 0 to 1 million jobs. So I think that's a pretty reasonable way of looking at it. Economists you can produce so many competing studies on the minimum wage, and the statistical methods that they're using to try to capture the effects of what happens when you raise the minimum wage are pretty sophisticated and certainly above my head. But I think that CBO estimate is a pretty good middle-of-the-road estimate. So the question becomes, are you willing to trade off up to 1 million jobs of people who currently have jobs to give other people, some of whom, but not all of whom, are poor? Some of these gains would have occurred to people who didn't necessarily need them. Are you willing to make that trade-off? And I think that's a good way of thinking about it.
It's interesting you say that. I didn't really want to turn this into a question, but just kind of a quick statement. You can imagine an enormous growth in the number of people who are net takers versus tax payers into the income tax pool simply because of so many people having these lower wage jobs and having higher dependency. So following that line, it's my personal feeling that the DNC's number one red state target, the one in fact with if they flip purple or full blue, would virtually guarantee a long-term lock on the moving us toward a one-party national politics. With that in mind, and thinking from an economics and jobs perspective, should we be learning a national lesson for Texas? I mean, is Texas an anomaly, or in your opinion, have the decisions that have been made both by the governor and by the legislature in Texas have had a profound effect on the economic performance that Texas has had in recent years? And should we as a country be learning from that and trying to emulate it instead of attacking it?
Well, I think that anytime, maybe you know the numbers that better than I do, but where you have one state creating, 40% of your, I'm not sure if that's the correct number, but, of your national jobs, then I think that you do need to at least look at that aspect of it and say, what can you take away from that? And, I think that a few answers suggest themselves really quickly. Right, we know that Texas is a low tax, low regulation state, but there's a few other factors, and it's a natural energy state as well. One factor to think about that maybe isn't mentioned is not as much is they have fewer housing restrictions of the kind that led to houses being overpriced in the first place, and in the run-up to the 2008 crisis, and so they had much less of a crisis scenario in housing there, and so they had fewer scars to remove after the recession began. That's one thing that I don't hear mentioned as much, but one possible lesson to learn. They also, closely related to that, they just have a low cost of living and very few zoning restrictions, very few land use restrictions. So if you want a house, you can build a house. If you're a home builder and you want to build homes, you can build them, and that's a big part of why they've had population growth, which is obviously a prerequisite for the kind of job growth they've had. So those are maybe two things to take a look at.
Joe, do you have time for one or two more questions?
Sure, absolutely.
Okay, great. I'd like to, if we can, first of all, I just wanted to make a comment, something that occurred to me during this conversation. And when we ended the unemployment extensions, it seems to me that the job market really started to pick up, and I think it would be reasonable to say that maybe it had something to do with it. And but also, I'd like to turn our attention to what the Federal Reserve has been doing. One, with the interest rates being almost kept unnaturally low, and two, with the massive buybacks and balance sheet adjustments that they've been doing. Now, I know they've been reducing it by, I guess, about $10 billion a month now, with the intention of getting rid of, bringing that number down to zero. But do you think that the Fed has actually hindered the economic growth in this, almost fight for them to hold back inflation, as they call it? But do you think this, and so can you give us a little guidance on your thoughts on this, and do you think it's been a good thing, and maybe do we need a little less intervention by the Fed?
Well, when you talk about the Fed, you have to keep two things in mind. That it has two roles. One is it controls the money supply. I think that's more of what you're talking about. And the other is it regulates our banking system. So you have to separate those two things. And since the Dodd-Frank financial reform law, the Fed has been way more active in regulating banks. And what that's doing to the economy is one question, but let's set that aside and talk just about what you mentioned, the interest rate policy and the balance sheet expansions. And that's a topic that is it's tough to get at. One way of looking at it, I think, is to compare it to what other big countries have done. You've had actually, let me back up to your earlier point about the market, the unemployment rate falling, and it's fallen pretty significantly since the long-term unemployment insurance benefits were ended in December. But even before that, over the course of 2013, we had a 1 percentage point decline in the unemployment rate, and that's even more significant than we've seen since then. And that was during the time that the Fed began this latest bond buying program. So in the most recent iteration, there has been pretty significant improvement in the unemployment rate, at least, if not the broader economy. But here's one way to think about it is just to compare it to what other central banks have been doing. And relative to the European Central Bank, the Fed has been pretty aggressive about buying bonds and signaling that it will keep interest rates low. The European Central Bank hasn't done any of that, and they also have done less. They've had less budget cutting than we have, and they have, in a lot of countries there, had a double-dip recession. So how to disentangle those things, it's a little complicated, but that's one comparison that I think is pretty helpful.
Yeah, that's interesting. And so let me just throw out a couple ideas. John and I always kick around some possible solutions to getting our economy back on track or creating jobs or resolving debts and deficits and whatnot. And I look at this argument recently of punishing corporations because they want to relocate overseas because of the high level of taxation, where I guess the fact that the United States corporate tax is higher than anywhere else in the world right now. Mm-hmm. And so I think common sense would dictate, at least in my opinion, that, well, if we lower the corporate tax rates to a level playing field with the competitors, then these corporations would consider staying here. And then the other part to that question would be, we always hear about all the international dollars of U.S. companies that are held abroad, and that, well, let's repatriate these dollars to be invested back in here. And what I've learned over time is that in many cases, the money, while it may be considered to be abroad, is actually sitting in accounts somewhere in the United States. Mm-hmm. So I say, let's make reasonable steps to encourage investment and innovation here in the United States, which would resolve some of the other things we've been discussing, such as jobs, higher pay, more stable economies.
Yeah, and I think that maybe the two sides aren't on that issue. Kind of in the big picture, the two sides aren't that far apart. President Obama has said pretty consistently that for that and similar reasons, he would like corporate tax reform. That's something that he's advocated and that his advisors have mentioned and have tried to seek common ground. How hard they've tried, I don't know. And Ron Wyden, the Democrat who chairs the Senate Finance Committee, also is a fan of corporate tax reform that broadens the base and lowers rates, and that's an issue on which he shares a lot with Republicans. I think the problem right now that they're having is this race that some companies are engaged in to merge with a company overseas in a jurisdiction with lower corporate taxes, and set up their headquarters there so they pay that lower rate. And you have the situation where Democrats and the president are saying, we can't get corporate tax reform done before they do this, so let's take a short-term step to cut that off using whatever legal means we have. And these companies are seeing that threat on the horizon, so they're acting even faster. So it's kind of creating this race to do these inversions, as they call them. So I think longer term, the corporate tax reform issue is becoming pretty bipartisan. But in the short term, they're going to have to figure out a way to handle this. And certainly the Republicans and Democrats are not on the same page as far as what measures can be taken to prevent companies from finding a home overseas.
Jim, we want to let you go, but I think we'd be remiss in not asking you or giving you a quick opportunity to explain. In the WashingtonExaminer.com today, you wrote an article regarding derivatives regulation. So I wanted to give you an opportunity to provide a quick comment on that, and especially in the context of what really strikes me is people are really getting so frustrated with our government and the lack of trust, and you touch on how this impacts influence peddling and what does that mean to us. So if you want to give us some quick commentary on that article, and of course we would encourage our listeners to go to thewashingtonexaminer.com and to read the full article themselves.
Sure. Just for some background, this is a federal agency that oversees derivatives. It's called the Commodities Futures Trading Commission, and that's another one that's been affected by the Dodd-Frank law. They were given the power to oversee the multi-trillion-dollar derivatives market, which is where financial firms and banks essentially sell each other insurance that pays out in the case of an asset going bust. And so the CFTC is now overseeing this huge market, and one of the commissioners just this week, Scott O'Malley, announced that he was resigning from his post. He was one of the five commissioners at the CFTC, and then 2 days later, the number one derivatives industry association, the ISDA, announced that they were hiring Scott O'Malley. So he went from the regulator to the number one association that represents companies that are being regulated, and a lot of financial reform groups immediately decried this as an example of the revolving door. I think it's an example, and as influence peddling, I think it's also an example of an agency that's little known, doesn't have a big profile, but is now powerful, and a trade association that's also pretty powerful. And there is some influence at stake here, but not maybe that much scrutiny as it merits.
Yeah, I find it interesting, and thank you for this article in the Washington Examiner. But just as an example, we saw Timothy Geithner leave his post to go to work with one of the big banks, and of course we've noticed that a lot of the guys in government have come from some of the biggest, Bank of America and the Goldman Sachs and so on and so forth. And I think it goes to a lot of the mistrust and things that guys like you are covering. That how are we supposed to have truly open and fair markets when we clearly see the relationships that get built between people as they go to from government to private back to government. I think it's a tough situation, really, in my opinion.
Yeah, I think that a lot of people agree with you on that one.
Anyway, Joseph Lawler, thank you so much for joining us today. Of course, you can find all of Joseph's articles at thewashingtonexaminer.com. Thank you so much for taking so much time with us today.
Thank you for having me on.
All right, thanks again.